Firstly, I mean, with HMRC, they do approve a range of different schemes which provides tax-efficient rewards for employees. But what I would say is that it's the size and the structure of your business that will actually dictate what scheme is right for you. And normally, I would say most schemes take around about 3 to 5 years to be able to actually where you can gain the best kind of tax treatment from those schemes. But I suppose the most important thing is, why do a share option scheme? What is the importance of it? I mean, why would businesses want to do that? Well, the aim, I would suppose, is for your employees. You might have certain key employees in your business which contribute towards the growth and the success of your business, or will be contributing towards the growth and the success of your business, and you want to retain those employees. You want to lock those employees with your company, and one way of doing that is by giving them some share options. Okay. One of the most popular schemes and one of the HMRC's approved schemes is an EMI, which is the Enterprise Management Incentive Scheme. Okay, so what is an EMI? I mean, basically, it's when an employee is given the option to acquire shares in their employing company, and that's at a future date, but at the current market value. So if, let's say, for example, I'm with a company, they've given me the option today, and the value of the shares at today's current market value is, let's say, £5. I've got this option now, and 5 years later I go and exercise my options, I get the shares, but I get them at the current market value, which was at £5. Okay, so that's how it kind of works. What's the aim for the employee? Well, they will kind of exercise the options that they've got, i.e. buy the shares, and they would want to do it when those shares have gone up in value, and subject that they kind of meet the scheme rules, there will be no income tax or national insurance charge when they come to exercise the option. But firstly, businesses have got to see whether they can actually qualify. You know, there's rules for companies, if the company can qualify, if employees can actually qualify into this scheme. I mean, there's pages and pages long of the legislation under EMI, but just to kind of briefly go through some of the key points on which companies can qualify. It's got to be a qualifying trade in the UK. So a qualifying trade, basically the company has got to have the intention of making a profit, i.e. it cannot be any investment related trade. They will not be able to qualify. Anyone in like land and buildings, financial institutions like insurance, they will not be able to qualify. The gross assets of the company must not exceed 30 million, and that 30 million limit is at the date the option is granted. The company has got to have less than 250 full-time employees, and again that limit is looked at the date the option is granted. The shares under this EMI options there can be restrictions with the shares. I mean, they definitely have to be ordinary shares, they've got to be fully paid up shares, you can't have redeemable shares, you can't have convertible shares, so they do come with a lot of restrictions as well. Who can participate? I mean, employees must spend at least 25 hours per week, or you can say 75% of their working time. If it's with the business, then yes, they can qualify. Employees cannot control more than 30% of the company, and that 30% has got to include even the options that they've got, which will enable them to acquire the shares. You've got to take those into account as well when you're looking at the 30% shareholding of that employee in the company. Okay. But I suppose just actually also looking at some of the limits, the company has a limit on the value of shares. So at the date the options are granted, when you're looking at the value of those shares, the company's limit cannot exceed 3 million, and each individual employee who's getting the EMI options, their value of those shares cannot exceed 250,000. So yes, EMIs does come with a lot of restrictions, a lot of limits and everything, but I suppose the most beneficial thing about them is the tax advantages that come with EMIs. Okay, so just looking at the tax treatments of EMIs, I mean, it's absolutely brilliant because firstly, when the option is granted for the employee, there's no income tax, no national insurance. When the employee then comes to exercise the options, obviously it's got to meet the scheme rules, there will be no income tax and no national insurance. When it then comes to sell those shares, so it's exercised the options, means it's got the shares, it then comes to sell those shares, then there will be capital gains tax, but it's most likely that the employee will qualify for entrepreneurs relief, and therefore those gains will only be taxed at 10%. So that's brilliant. And for the company, it's a bonus because the company can actually claim a corporation tax deduction on the increase and the growth on the value of the shares. So the benefit which is received by the option holder who's got these shares, whatever the increase in the value is, the company can actually claim a corporation tax deduction. So that's like a bonus for the company, I suppose. So I mean, it's EMIs are just great when it comes to the tax advantages. Just comparing that with unapproved share options, I mean, unapproved share options don't come with restrictions. They don't come with any kind of limits or anything. When options are granted under unapproved share options, if you was to give these to your employees, there's no income tax charge, no national insurance on the date of grant. But when you come to exercise the option, when the employee comes to exercise the option, there will most likely be an income tax charge, and that income tax charge will be on the increase in the value of those shares. And then when they come to sell the shares, there will be a capital gains tax charge as well. Okay, so what is kind of like the key point to kind of take out of share options? Just to mention, just coming back on EMIs, you know, where you can, when they come to sell their shares and you can claim for the entrepreneurs relief, the government has relaxed the rules on entrepreneurs relief for EMI share options, because the only criteria that you need to meet is the 1 year rule, okay, and that 1 year rule will start from the date of grant the date the option has been granted. So as long as the employee has held the shares for 1 year, or the option over the shares for 1 year, and it will be able to qualify for entrepreneurs relief. And that clock kind of starts from the date the option has been granted. So it's a lot more easier to actually qualify for entrepreneurs relief for EMI option shares than, I suppose, if you just generally subscribe for shares within a company. And I suppose that is kind of like the key point to kind of highlight here, is that if you can kind of get, like, you know, shares via the EMI option way rather than just subscribing for shares, then you know, to get for entrepreneurs relief is much more easier to claim for entrepreneurs relief under that route than it is for subscribing for shares. Okay. Just moving on. Purchase of own shares. Okay, I would say purchase of own shares, another useful planning tool for owner-managed companies. You know, it's great. When would you use this? Various times you could use this. I mean, let's say if you're facilitating an exit of a shareholder from a company, especially when there's no third party, you know, interested in acquiring the shares, then you could do a purchase of own shares. Layla mentioned earlier, like management buyouts, you could do it to carry out a management buyout. And I suppose you could even just do it to extract value out of the company, but provided you get capital gains tax treatment, capital treatment, and you can actually claim entrepreneurs relief. But as Layla also mentioned, it does come with a lot of requirements, so you've got to meet the requirements to be able to go for a purchase of own shares. Okay, so what are these requirements? Firstly, to do a buyback of shares, it's got to be done out of distributable reserves. So if the company doesn't have distributable reserves, then this is a no for you. You can't do it. Other requirements, the shares have got to be fully paid up on purchase. There's no limit on the number of shares that can be bought back, but once the shares are bought back by the company, they've got to be cancelled immediately. And there's various documents that needs to be produced, and one where the shareholders have got to pass a written resolution to be able to do a purchase of own shares as well. So it does come with various requirements. What is the tax treatment for purchase of own shares? Generally, when there's a buyback of shares, it is treated as a distribution. So it will be taxed as a dividend, and that will be subject to the income tax rate. So the effective tax rate for dividends, if you're a higher rate taxpayer, is 25%. Okay? But if you meet certain qualifying conditions, then the consideration, the gain that you're getting for this, the purchase of own shares, you can go via the capital treatment, and then it will be taxed under the CGT rates, okay? But there's various qualifying conditions, such as it's got to be an unquoted trading company. The reason why you're actually doing the purchase of own shares have got to benefit the trade. It can't be part of a scheme. It can't be part of any kind of arrangement. The vendor who's actually selling the shares, they've got to be a UK resident. They've got to own the shares for at least 5 years. But if they've inherited those shares, then the time limit is 3 years. And when the vendor, once it's sold its shares back, it's got to reduce its holding by at least 25% or more. And after the buyback, it's got to have at least less than 30% of the shareholding in that company. So it cannot have more than 30% of the shareholding in that company. So it comes with, there are various qualifying conditions. If you meet these qualifying conditions, you can get the capital treatment. What that means is that once you're selling the shares back to the company, the consideration which you have received, that will be taxed at basically at the capital gains tax rates. Obviously, even more better, if you qualify for the entrepreneur's relief, it will be taxed at 10%. But the key thing here, again, which I will mention, is we would only advise you going down the purchase of own shares routes, is that if you can qualify for entrepreneur's relief and get the 10%, then go for purchase of own shares. Otherwise, it just doesn't make sense, because if you look at it, if you're a high rate taxpayer, you qualify for the capital treatment, you're going to be taxed at 28%. You'd rather get it as an income, as a distribution, you'd be taxed at 25%. So there's no point going down the capital treatment route. Unless you know, before you do a purchase of own shares, you've got to know whether you meet the entrepreneur's relief rules, the conditions, and your gain will be taxed at 10%. And I think that is the crucial kind of point there. So definitely, the planning needs to be done before any kind of purchase of own shares or any kind of disposal is made. So that I think is the key point there.